Well, good afternoon, everyone. This is Tony Whitbeck. I'm the CEO of Key Management Group, and welcome to today's presentation. We have two speakers with us today. We have Todd Doherty. He's our Director of Acquisition and Legacy Planning, and he's going to walk you through business valuations and industry trends. And then we have a special guest. We have John Turner from Live Oak Bank, and he's going to talk to you about the financing of practice acquisitions. Before we get started, I want to spend just 1 minute giving you an overview of the services that we provide at Key Management Group. We offer some practice management services that provide strategic leadership, operational performance, and then a program called Complete Practice Management. We offer some outsourcing services around client meeting preparation and financial planning. We have a whole host of human resource services, and then we have a number of acquisition and legacy planning services. They consist of business valuations, turnkey continuity planning, deal-making services, an escrow service. We have our advisor legacy platform where we help people buy and sell practices. And then we also have our elite buyer program. And so this particular presentation for the first part is going to be regarding business valuations, and that's going to be presented by Todd Doherty. So with that, I'd like to turn it right over to Todd so we can get started. Todd?
Thank you, Tony, and thanks to all of you for joining us today. As Tony mentioned, we're talking specifically about valuations, and then John is going to join us to talk about how to finance the purchase of a practice. And those two things really do go hand in hand. You do need a valuation to help chart the value of the practice prior to planning for an acquisition. That valuation can certainly also help you determine what are the best financing options based on cash flow considerations provided in the valuation deliverable, or at least in our deliverable. And during the underwriting process, if you decide that bank financing is the best route to go, and we would say that it is advantageous for both parties, oftentimes a valuation will be a requirement of that process, and I'm sure John will touch on that. So I'm going to go through the valuation piece, a little lighter in some areas than we do in our standard valuation presentation, but really want to give you a good overview of what a valuation is, what people use them for, how value is assessed, and really the overall consideration of using a valuation and the worth of doing so. We've noted over the years that there are a lot of misconceptions about what a valuation is intended to deliver, what items are valued in a practice specifically, and what types of valuations you might use for different circumstances. So in order to get a common understanding, I thought I would just really work on the basics to start out with and talk about, first of all, what is being sold when a financial advisory practice changes hands. And what is being sold is an asset, and the asset is the goodwill of the client group. And then to a lesser extent, the goodwill of the selling advisor, in as much as they can help the clients transition and stay with the buying advisor. If you think about it, the reason it's a goodwill sale is that you don't technically own the clients. What you own is your ability to generate revenue from them by managing their assets and selling other products to that client group, and hence it is a goodwill sale. Larger practices also include the value of the enterprise, or simply stated enterprise value as we refer to it. And the reason is because as you get into a larger practice, it's not simply a book of business sale or a client group sale, but you're really purchasing the ongoing operations of that practice. It could be that they have multiple team members, associate advisors, assistants, planners in the practice, and so forth, that you would really need to maintain in order to purchase that practice. And that enterprise and those systems that they've developed contribute to the efficiency or inefficiency of the practice, as it may be, which impacts the profitability, and certainly that's a consideration of value, and it also impacts how you would finance the deal based on having a fairly significant impact on cash flow. So what the goodwill provides to the buyer, first of all, is the client assets under management. So Hopefully, when you purchase a practice, you're going to receive those assets, or at least the majority of them, and then be able to receive the revenue from them. The second item is the revenue produced by managing the assets. That's fairly straightforward. You're going to have some assets that produce recurring revenue, other assets that have produced transactional revenue in the past, but maybe repositioned in the future to either produce transactional revenue again or be converted into a recurring revenue asset. And then lastly, and this is an item a lot of people don't really think about much in respect to a sale, but you're also buying a subset of goodwill, and that's the goodwill of the client group themselves. So those are the additional opportunities outside of the assets that you're literally purchasing, for bringing in new assets, for referrals to new clients. They might be bring about other centers of influence within the companies that they work for, their social groups, etc. And that item really shouldn't be overlooked. I think a lot of people don't think, about that goodwill element. And one of the reasons why it is important is it's a contribution factor to the projection of growth of the practice. And so a good client group is going to have, excuse me, probably more value in that goodwill bucket, if you will. So with that in mind, what's being valued really is the quality of the client group and the revenue that they produce and the future opportunity with that client group. It's also important to understand what is not being valued, and this is a common misconception. And what we don't value, and I can't speak for other providers, but I would imagine this is consistent, is the portfolio choices of the selling advisor. Frankly, it's a matter of opinion. 10 advisors would have 10 different opinions about where to invest their clients' assets. And so, except for the impact on revenue quality, recurring versus transactional, we don't value the portfolio choices. The deliverable of the valuation itself, for a standard valuation in our industry, is what's referred to as fair market value, and that's the value between a willing buyer and a willing seller. So we get a lot of, there's a lot of variety in why financial advisors purchase a valuation. Just quickly go through a few of those things. Certainly to manage the equity in their practice. And for most advisors, the asset that is their practice is their largest personal asset, or at least one of them. For any type of agreements, if you're going to buy or sell or enter into a continuity agreement, having an accurate valuation, a third-party valuation, is very important. I'll go more into that. We get situations where people are building a team, and certainly they want to incentivize that team with some type of equity arrangement. So that's another common reason for valuations. Certainly for a sale or for the acquisition of a practice. As I mentioned, many bank financing procedures require a valuation in the underwriting process. And then lastly, and this is one that is not on our list but should be, it can actually help you manage the profitability of your practice. Our valuation deliverable will compare your practice to similar size practices in respect to efficiencies and profitabilities, expenses, so on and so forth. And I think that's one of the most valuable parts of the valuation deliverable. Another common misconception is that there are actually multiple types of valuations for very specific purposes. The standard valuation that you would be familiar with in our own industry, and those valuations are usually around a price point of around $1,200 to $1,500, is what's known in the valuation industry as a calculation engagement. The name is a little bit misleading because I think people tend to imagine that as a simple calculator of value, and it's certainly not. What that term refers to is that the valuation provider has defined the methodology of value as opposed to following standard methodology of value. They've customized the methodology. Virtually every provider that you're probably familiar with in our industry is providing a calculation engagement, whether they know it or not. That is the type of engagement. That being said, there are other very specific types of deliverables that are normally more in-depth, take quite a bit more time, and hence have much higher price range for those valuation engagements. Some examples of that would be valuations for divorce, valuations for equity ownership where there's stock. There's other types of valuations for limited marketability considerations. And we provide those engagements as well. We have a CPA on our team who holds 2 certifications in valuation, and he provides all of the what we refer to as specialty engagements. We also provide other types of valuations, some of which are related to our industry. For CPA firms, we can value OSJs. In some cases, there's some funds that we've valued in the past. So really a wide variety of things. And we can really facilitate any type of valuation. We do work with several of the lenders in our industry, certainly Live Oak Bank we have a very close relationship with, and we're an SBA valuation provider to those lending institutions. One of the things that we've noted over the years is that financial advisors, and this is probably true for any business owner, they really like to understand what are the benchmarks of value, what are the averages in our own industry, what are the multiples for recurring and transactional revenue. I mean, I get that question quite often, but unfortunately, we've also seen advisors use those rules of thumb or averages to value a practice for an actual transition. And frankly, that should never happen. And I'm going to show you why that could be a very serious mistake with fairly impactful consequences monetarily. So the visual that you see on the screen right now represents our average valuation as of the end of 2017, so pretty current. And that value, the average size practice was 100 million in assets under management with GDC or production of 764,000. And for that average size practice, the average valuation was $1,531,000. Quite a milestone in itself that the average value of a planning practice is now over $1,500,000. So that's something to be said just in itself. In terms of multiples, the average revenue multiple, and that's of gross revenue before payout, hovers just around a multiple of 2. As a percentage of AUM, it's about 1.5% of AUM. The significance of this analysis, though, was we also looked at the range of value. And so we did that by looking at the bottom 20% and the top 20%, and we applied that range to, again, our average size practice. You can see here on the screen that the bottom 20% valuation result would come in at $1,374,000, and the top 20% at $1,759,000, representing a range of 25%, or in dollars, and I think this is a case where dollars are more impactful, almost $400,000 for an average size practice. So getting back to the idea of using multiples, you could imagine that if you were lucky, and you're discussing an average size practice, you could be within a few $1,000s. That wouldn't be a terrible result, I suppose. Certainly more expensive than the cost of evaluation, even at that. But, if you have a practice that's not average, you can pretty easily be off by $100,000 or more. So certainly, it makes a lot of sense to use a professional third-party evaluator in any circumstance where it's, the results are meaningful. In our own valuation methodology, we use 2 different approaches or methods of analysis. One is a market-based approach, and what we do there is we compare the key metrics of the practice to our own benchmarks developed in our process, the averages for all the valuations that we do. By making that comparison, we can determine the overall quality of the practice. Is it above or below average? And then based on that, how does it compare to similar quality practices that have sold recently? And so that approach is really based on what we feel the market would bear. We're comparing items like the quality of the revenue. Is it recurring or transactional? Certainly the quality of the client group based on segmentation, items like client age, asset velocity or return on assets, and again, comparing those to our benchmark. The second approach is an income approach, and this one is really reflective of the enterprise value that I discussed earlier, and specifically really the profitability of the practice or the lack thereof. And so in that approach, we're using a discounted cash flow calculation to value the future revenue stream, and that future revenue stream is discounted for time. And so the further out you go into the future, the less valuable that revenue stream is worth. The things that impact that, as I discussed, would be really things that either create efficiency or inefficiency. And so that would be the team, systems put in place by the advisor and team, and ultimately how do those things impact the P&L. I talked a little bit about, really this analysis or enterprise value, if you will, is becoming more heavily weighted over time because practices are getting larger. And the larger that they get, the more impactful the enterprise value becomes, because certainly you can't purchase that practice and unwind it. You're going to have to keep, that team and those systems in place. Some of the trends happening in our industry, or those that we feel are likely to happen, are having a pretty significant impact today. And I think we're entering an interesting time. Values have been very strong over the last 7 years, and it's certainly been a seller's market. Any practice that comes up for sale has quite a significant demand, but we're likely to see some changes there. There's some pretty impactful external forces at work here that could have the result of putting a downward pressure on value, I think, at the least. And if you think about the reason for the most of the gain in value over the years has to do with the growth of the practices, not as much as the demand. The demand is significant, but it hasn't had as much impact as the growth of the practice. And so we've already seen that item trail off. But let me talk about a few other pretty significant trends. First of all, supply and demand. Many of you are probably familiar with, the idea of the baby boomer, the age wave, as they refer to them. And what we're looking at in the US is over the next 7 years is a record number of business transitions, and our industry is certainly no exception to that. On top of that, there's a relatively small number or small percentage of advisors who are younger coming up in the industry, and so that combination is not a good one. Likely what we're going to see is, roughly 40 to as many as 50% of the advisor population retiring over the next 10 years, and a decreasing number of younger folks who are going to be able to purchase those practices. We started seeing a shift in the beginning of 2016, actually. And our feeling is that we're going to gradually move from what has been an extremely strong seller's market into what you would refer to as a buyer's market over the next 5 years or so. The initial portion of that shift was really not quite as strong a demand, and that doesn't mean there's not plenty of buyers. There are, but the demand wasn't as strong, and especially for smaller practices or those that were not as high of quality. The cost of capital can be a factor because many transactions are bank financed today, and if interest rates go up, that could impact the use of financing, certainly, and there's a pretty direct correlation to interest rates and price. Client age is certainly a factor, and unless you have a larger team practice with younger associates in your practice, it's likely that the client age in your averages of all clients, or certainly your more affluent or high value clients, is increasing year after year. If your practice gets to the point where that average is near or above the age of 70, then you've reached a bit of a tipping point in respect to value, because it's hard to assign a growth rate to a group like that. We've been expecting the stock market to shift a bit, perhaps going into a bear market. That hasn't happened. But despite of that, and this is interesting, practice growth trailed off significantly starting really in January 2016. We were tracking average growth rates of 12 to 14%, and by the end of 2016, that average growth rate has gone down to less than 1%. So far, it's recovered to only about 3%, but certainly significantly lower than we anticipated. And most practices where the advisor is within 5 years of retirement actually have negative growth and negative asset flows. The other item that's a trend really is the increasing complexity of a practice, being a practice owner, dealing with the compliance, technology, marketing requirements, and so forth is really, and I hear this all the time, is really becoming very, very difficult for a solo practitioner. And I think that could be one of the primary reasons that's driving people out, because of it's just too difficult to keep up with that if you don't belong if you're not currently in a team situation. I talked about the quality of the client group being one of the most significant factors in our own assessment of quality, and we basically segment the clients into 3 groups: basic clients below 100,000, high value clients between 100 and 500, and affluent clients above 500,000. You can see here on the screen what an average practice has in those groups of clients in terms of the ratios. And really what's significant about segmentation is, the fewer clients you have in the basic group, and really efficient practices have about 25%, and the higher the ratios in the affluent group, the more valuable the practice is. It certainly is highly correlated to profitability increases as a client segmentation increases, and really is a much more efficient practice. Those are the kinds that people are really willing to stretch in terms of the price, because they don't see very efficient practices too often. Most are average, of course. So this is a big focus of our analysis, is looking at client segmentation. You can see on this slide that we actually we looked at how does segmentation impact profitability, and the impact is pretty clear. I mean, we kind of knew this anecdotally for quite a while, but then we did some data mining to confirm our assumptions, and it turns out that those assumptions were correct. So you can see here, looking at the bookends of this study, a practice that has only 16% of their clients in that basic client group has a profitability ratio of 66%. A practice that has a higher percentage of those basic clients has a average profitability ratio of 54%. And I think, and I would predict that this trend is actually going to increase with time as practices continue to get larger and larger, and there's more consolidation due to the relationship of client segmentation and efficiency, or lack of it. We talk a lot about, what are the averages that are driving value, what are those metrics that are highly weighted in respect to value in a practice. I just want to point out a couple of those things. I won't spend a lot of time. In terms of recurring revenue, you can see here, and this is an interesting metric because it's increased about 6% in the last 3 years. The best, or the top 20% in terms of recurring revenue now, is in the mid-90s. It used to be fairly rare to see a practice with 95% recurring revenue, unless they were an RIA, and now it's becoming relatively more common. The average now is 82%. That used to consistently hover around 78% or so, and it continues to climb even since we created this slide. Average client age is another very impactful item. The average age, excuse me, of all clients being 60 years. When you get into the high value and affluent clients, it's reaching around 65 years. And, there's quite a range. And again, as I mentioned, where that really becomes significant is where either the overall client group or certainly the high value and affluent clients within a practice are near or at 70. And then I definitely consider that a tipping point in value because growth is a strong consideration of value, and you'd have a difficult time applying growth to a client group of that age. Normally they'll be, withdrawing assets, in some cases passing away, but certainly you'd have likely negative asset outflows. A couple of other items, we talked a lot about efficiency and profitability, and again, I think it's becoming more and more an important consideration. One thing that advisors are probably not aware of in general is that as practices get larger, they actually become less profitable. So that's a challenge in our industry because practices are getting larger. And there's quite a range of really, the results in respect to efficiency and profitability. So you can see here in terms of overhead expenses, the best practices are, around the 51% range. Really, the best of the best are closer to 35%. And then we're seeing some practices as high as an 80% operating expense ratio. And most of those are, in fact, quite large practices, which are really struggling with profitability. So that becomes important. If you look at that in terms of operating expenses without owner's compensation, removing that item, then the bottom 20% or the best is around 25% expense ratio, and the worst is in excess of 52%. So a huge range in how people are operating their practices. So just briefly about our own valuation process before we hand it off to John. As I mentioned, we use two different methodologies of value. Our standard valuation in our industry, the calculation engagement that I discussed earlier, is $12.95. If you happen to be an advisor in one of our partner firms that you can see on the right-hand side of the screen, you get a discount of $8.95. The reason for that discount partially is that we've really streamlined the process for those advisors in the partner firms where we're collecting the majority of the data from some very specific reports that we give you instructions to collect. And that really makes it a lot easier for the advisor. It also makes it easier for us to get good, accurate data. And so as a result of that, we pass along a discount because of it. One of the areas of our deliverable that we find people really probably find the most value in is every time we deliver a valuation, we'll spend an hour going through the results with you. So regardless of what reason you purchased the valuation, we want to make sure that A, you understand the results, and so we'll do a thorough review of them. B, answer any questions that you have. And then lastly, and most significantly, how do you use those results to achieve your goals? Whatever that may be, if it's an acquisition, if you're planning around succession or continuity planning, we can really provide a lot of great insights as to how to use the results. So with that, I'm going to turn it back over to Tony. Thank you.
Great, thank you, Todd. Great information. You can purchase our valuations right online on our website. You can see that our website address is keymanagementgrp.com. You can click on services, and then you can see the drop-down menu. You go to assess your practice, and then business valuations. Again, you can order it right online, and that's what gets the process started. I'm going to change slide presentations here, and I'm then going to turn it over to John. John is with Live Oak Bank. So give me 1 second to open up his presentation. Where did it go? I had it right here. All right. So with that, let me introduce John Turner. He is with Live Oak Bank. Live Oak Bank is a partner firm of ours. We do a lot of work with them, and John's going to walk us through the trends in financing and the work that they do to provide loans to you. So, John?
Thanks a lot. I appreciate that, Tony. And again, my name is John Turner, and I started my practice back in the mid-1980s, and I spent 30 years either as an advisor or a practice management expert, if you would like to say that. And one thing, kind of to what Todd talked about earlier, one thing that really caught my attention when I was sitting in leader of a practice management group was basically a study came out from Accenture. It was like 2014 in the fall. And of course, typical, of most studies, there was all kinds of details in there about average age of advisors and so forth. But what really caught my attention was the AUM factor, and the fact that, according to this study, within 10 years, they were expecting $2.3 trillion in AUM to change hands. So it is clear that we're entering into a time of harvest, kind of a once in a career type of opportunity. So it's really good that you're actually on the phone and that you're learning more about valuations and about financing as a way just to get kind of smart around this topic. So again, I congratulate you for that. So Todd talked about valuations. So we're going to talk about how do you monetize that valuation? How do you get the money out from that valuation? And today we're going to talk a little bit about really kind of the 5 ways that you can finance a deal, and then we're going to dive into bank financing, particularly the way Live Oak Bank does it. So with that, Tony, if you'll hit the next slide for me, just going to introduce Live Oak Bank very briefly. We are the only FDIC-insured national bank that was specifically chartered to do cash flow goodwill lending to investment advisors such as yourself. And again, you've got folks like myself with 30 years in the business that really understands your practice and understands what you're trying to do. We do 83% of the financing when a bank is involved in our industry. And I would say the most important thing at this point that you should know is that we are very, very focused on winning the deal. Yes, rate, term, very important. We'll get into that. But frankly, if you lose the deal, it becomes a moot point. So we really try to apply our resources to help you in partnership with Key Management Group to win the deal. So with that said, Tony, if we'll dive to the next slide, let's talk just a little bit about kind of some of the things that we do. So this is a breakdown of the various different types of loan that we do. And I should replace this. We're at $600 million right now in the loan portfolio. But we do loans for commercial real estate. If you ever want to own your building, certainly can do that, 25-year term. Actually, now we've seen an uptick in refinances. It's now 12% of the business that we're doing. And 2 reasons seem to be driving that. One is we'll see that the relationship has soured a little bit between the buyer and seller, and so the buyer will come to us and say, I'd really like to refinance the loan to, really have the kind of the seller move on. The other one we've seen lately is that, most seller notes are 3 to 5 years in term. And here's an important point for you. We do 10-year term with no prepayment penalty. In fact, you pay it a little ahead, the loan will re-amortize and your payments will drop, so you can actively manage cash flow. So we've seen a number of advisors starting to come to us with the idea of, I want my cash flow to be more robust. If there ever is a downturn in the market, I want to be more resilient. And so we've been seeing an uptick, I think, in refinancing for that. But today we're really going to talk mostly about acquisition and succession. So just to kind of dive in here, really 5 kind of different ways that you can finance a deal. And we've got it now broken here in 4, but you can do earnouts. And there's really kind of 2 types of an earnout. There's an earnout for a fixed period. That's basically where you might agree to say, look, a seller, I'll pay you 20% of the net revenue for the next 5 years. And whatever that amount comes to, that'll be the amount. So the revenue might wax and wane over the years, depending on market performance and so forth. But whatever that ends up being, that amount, that's yours, and you agree to that. The other type of earnout that we see sometimes is fixed amount, where it's, okay, seller, I'm going to owe you $500,000. I'm going to pay you 20% of the net proceeds from the practice, until we hit 5 million. That may happen in year 3, it may happen in year 5, depends on the performance of the organization. We don't see a lot of earnouts anymore, not like we used to. It used to be kind of a standard fixture in deal components. Really haven't seen it that often lately. And again, if there is an earnout involved, most likely bank financing won't be involved in that because of some bank regulations that are out there. Another thing, of course, is cash. You could bring your own money to the table. We've seen less of that lately, mainly I think because if you bring cash to the party yourself, how often can you actually recover and buy another practice? Again, it's harvest time. So a lot of our customers at our bank do somewhere between 2 and 6 acquisitions. And again, because they're using our money, they can continue to acquire and acquire. If you use your money, you may have to wait for it to recover before you're able to do your next acquisition. So you tend to be a little bit more rapid fire if you can use someone else's money to acquire the deals. And then seller notes. We still see a fair amount of seller notes. Again, 2 types, fixed. It is what it is. There's a certain rate. There's a certain time frame on it. There's a certain amount of principal, and that's it. The other type we see is variable, but it's not variable on the rate. It's variable on the principal, usually based on transition and how many clients actually transition over versus how many clients attrit out of the practice. And so the principal might vary. It might be reduced if not all the clients come over, for example. So see a couple different types of seller notes. Usually 3 to 5 years is what we see for the length on those. There's been an uptick on the interest rate. I think the average we've encountered ourselves, and it may be different for others, is about 5.7% on seller notes. And then, of course, you have bank financing. And, again, we're going to talk a little bit about Live Oak Bank. So just kind of dive to the next slide. Couple of things, before we dive into here that people typically have questions with. One was term, 10 years. The other one is rate. I'll mention that as well. We do loans from $75,000 up to $7.5 million. If we're doing a loan around $7 million, our rate is basically prime plus 1. Rates really are driven by size of financing. If we were down, say, at $350,000, we'd be at prime plus 2.25. So about 125 basis points swing, from $7 million down to $350,000. Now, talking about structuring and what we've seen and what's, kind of where the industry seems to be going, if you would have talked to me back when I was managing a practice management group for a large PD, I would have told you standard deal structure, and it was almost gospel. Standard deal structure, 1/3 down, 1/3 in an earnout, 1/3 in a seller note, usually spread out over 3 to 5 years. I used to call it a third, and a third over 3 to 5 years. Since bank financing has become involved, it really has shifted the market to much more cash up front, leveraging a bank. And in fact, what we saw as averages last year on deals that were over $1 million was typically about 19% still held in a seller note, on average 81% in bank financing. But there was a change in the banking regulations that took place about a year and a half ago. And Tony, if you'll shift slides, we've seen this move now to 100% financing. And I think, in fact, of the last, 97 deals or so that I've been a part of, all but 2 were 100% financed. And I think there's a couple of reasons why we're seeing the drive to 100% financing. First, for the buyer, obviously they're going to get to put everything on 10 years. And again, there's no prepayment penalty, so they pay it off anytime they want. So 10 years with flexibility. So it ends up cash flowing usually much better, and ends up cash flowing from day one, where the old 3 to 5 year deals that we used to see, most of the time those cash flowed negatively. So the buyer essentially, I used to jokingly say, would be forced to eat ramen noodles and hope and pray that the market doesn't go down. But again, now for them, cash flowing positive from year one, it's much easier to basically to withstand. If we ever did have a downturn in the market, you actually can start making net flows stronger for yourself from day one. So it seems to be a good thing. Now, most buyers are not going to give a big check to the seller and then allow the seller to just walk off. they're going to want to have some sort of warranty, some sort of assurance that the seller is going to help with transition. And that's where you can employ an escrow account. And again, Key Management Group provides escrows, so it's something that we can explore with them. But essentially what happens is in day one, at close, our funds are wired into the escrow account. Typically there's an agreed amount that gets released on day one, holding back the remainder pending successful transition. And this creates a very powerful motivation on the seller to transition well. There's not a question if the check's going to be cut to the seller. It's already there. I suppose the seller could go to Key Management Group and count it if they wanted to. But it creates strong motivation on the seller's part to do a great job with transition, so another plus for the buyer. For the seller, what we're seeing, what they're attracted to is the fact that they've offloaded all risk to the bank. And you would say, what's that risk? Well, risk that the market goes down and the buyer can't pay the seller, or the buyer becomes depressed and stops working, can't pay the seller, or heaven forbid the buyer's spouse divorces them, cleans them out, and they can't pay the seller. So there's lots of risk there, and again, the longer the term that was on the seller financing, the greater that risk would be. Well, now it's all offloaded onto the bank. So the seller's pretty excited about that. They're going to be able to step out of the business and not ever have to worry about getting relicensed and coming back into the business. The other thing that sellers like is that escrow account. That escrow account had money coming out in tranches, and those tranches had conditions on them, so it's called conditional receipt of funds. So it is possible that the seller will actually be taxed in tranches in the year that it's received. So while it's not meant to be directly a tax planning strategy, it becomes a tax planning strategy for the seller. And of course, I'm not an accountant, so please see your CPA on that topic. So we're seeing this rush. But here's the thing. 100% financing isn't for everybody. It's not right for every situation. So let's talk about the hurdles, the 3 hurdles that you have to go through in order to get 100% financing. The first one is going to be the loan size. We can finance up to 100% of the third-party certified valuation that Todd and his crew does. So when you do a valuation with Todd, there will be a value that's right on the front page. We can finance up to 100% of that. I do say if sellers are just crazy enough to ask for more than what the practice is worth, and you're, as a buyer, if you're just crazy enough to pay it, that ends up being a seller note on top of our note. And that's essentially what happened in the 2 scenarios of the 97 that I just mentioned. The other 2 things, injection rule, we'll talk about that in just a second on the next slide, and then cash flow. So let's talk injection rules. And this really is what had changed over the last 18 months. And essentially, if we're doing a deal, we're going to look for a 10% equity injection. It used to be that there were really only 2 ways to solve for an equity injection. One was bring cash to the party. That was kind of the painful way. The other way was that you could work with the seller and use a seller note on full standby. Well, now with the banking regulations changed, there's a third way. We get to count the equity that you already own from your own practice. So just using a real brief example, let's say your practice is worth $500,000. And let's say that you're going to buy a practice that's worth, let's call it $1 million. We would assume that the new business would be worth about $1.5 million, of which you already own $500,000. You own essentially 33%. You have a 33% equity injection, more than covers the 10% requirement. And that is the change that has really made 100% financing available. But again, we said there was a third way that you qualify, or a third hurdle, and that is around the way that we do valuation, or the way that we do qualification. Let's go past this one. Let's just dive right into how they're going to qualify. I already talked a little bit about rates and terms, so let's move past this as well, Tony, and we'll just dive right into how you qualify. Really, to boil this slide down and the next slide, there's really 4 ways that you're going to qualify for the loan. The first way is that you're going to need a credit score of 680 or better, and that's on the lowest of the 3 reporting agencies. Be careful. Some people look at CreditWise or Credit Karma, see that they're at 690 and go, whew, I'm in. Well, that's an average. We look at the lowest of the 3. So you really have to look at all 3 of the reporting agencies and look, and we look at the lowest one and look for it to be 680 or better. Also, we want to make sure there's no real bad stuff out there like bankruptcies, foreclosures, that kind of a thing. If there's a late payment or two, we can swing with that, but if there's any kind of a bankruptcy on it, that's probably going to be a hard stop for us. And then making sure that you have a really good track record in the industry. Again, when you look at your U4, you can have client complaints. That happens. But if there's a theme or if there's something egregious out there, that may cause an issue for us. But what I didn't mention yet was the debt service coverage ratio. And Tony, if you'll hit the next slide, let's talk just a little bit about that. And it's a math formula. And here's the thing to remember about this. You're not a coffee shop. You don't have coffee equipment to collateralize. You're a cash flow goodwill business. So we do pay attention to cash flow. And what we do is contemplate what your future merged organization is going to look like and what will be its ability to pay business debt. And so here's kind of how we get after it. We're going to take your revenue, add to it the revenue you've acquired. We're going to subtract your expenses, plus we'll subtract the expenses you might have inherited in the acquisition. We're going to use a formula to come up with some owner's compensation. So you can pay yourself whatever you want, but we'll use a formula. We'll subtract that. It's going to leave us with net operating income. That'll be your business's ability to pay business debt. We don't want to take it all, because what if there was a downturn in the market? We could leave you in a really bad place. So what we do is divide it by 1.75, and that will be your maximum payment that your business can afford. Or another way of thinking about that is all business debt payments would have to fit under that number, whether it's from a previous acquisition or whether there's a seller note that's involved that would have to fit under that, or our bank note. So all of it needs to fit under that number. We call that cash flowing. And basically the fourth and final way that you would actually qualify is we look at any other businesses that you have in your particular situation and make sure that they qualify as well. So probably the real quick example of that is we did have a lady who had great cash flow. Her net operating income was $5.5 million, but she did have a TV show. Someone had complimented her on her outfit, so she decided to start a clothing line. Unfortunately, the clothing line was losing $6 million a year. And she had actually refinanced her house twice just to keep her head above water. So where the business cash flow looked great, her global cash flow looked really, really bad. So that's what we mean by kind of that fourth and final, kind of use the same formula on any other businesses you might own. Moving ahead, Tony, let's this is a good example of kind of what we're talking about, and that is, kind of how the 100% financing could work. Basically, we could assume that we've got a seller who's ready to exit the business. They want to do 100% financing. They're going to use an escrow of 25% or $250,000. We can do a whole $1 million note. In this case, it was a prime plus 2%. The debt service on it then was $140,000 divided up into 12 monthly payments. There was $235,000 potentially for a seller note on the 25%. But if you look at the bottom, the cash flow revenue from the business was about $400,000. Taking out this was a registered rep, so taking out the payout that the broker dealer had gotten, and taking out the cost of production and the debt service, it ended up with a positive cash flow from day one of $60,000. So again, most of the time when we have a 10-year term, they positively cash flow from year one, and that's kind of the thing that we had talked about previously. So a lot of people ask about, how long does it take to get the loan? On average for us, it's 37 days. And again, I always talk about averages as not applying to anybody. You would be quicker or slower. But basically, what would happen is when you found a deal, most likely through Tony's group with Advisor Legacy, you would give us a call, and you would give us the information, and we'd put you into our system. It would take you about 90 minutes to do your forms, 5 or 10 minutes to do your signature, and then you'll upload some documents. And that's really kind of that second point, bullet point, forms, documents, and signatures. But once everything's in, we'll do some underwriting. It won't be 100% underwriting, complete underwriting, but we can do enough underwriting in just a couple of days to be at 95% confidence level it's a doable deal. And we'll send you a proposal letter. That's that third dot there. And you take a look at that and you ask yourself, does that make good business sense? And if it does, you'll accept. It's non-binding for you, but it's enough for us to go ahead and spend the human capital to finish up the underwriting. Takes us about 10 business days on average to do that. Acceptance, which is the second to last bullet point, takes us 0.67 days. That's where we go to the credit officer and we basically present the case to them. And credit officers, they're very powerful in the bank. They're the ones that stand at the doorway of the vault. They ask the question constantly, can she, will she pay us back? Can she? Science and math. Will she? Art, feeling, gut feeling. So it's very important to know your credit officers, know what's the best way to present it in a way that they can be comfortable with it. And again, for us in our group, our credit officers literally sit about 15 feet from us, and we know them well, and we know how to do that. But after acceptance, then it takes about 4 weeks to get through closing. And here's the thing that I'll say about that. I know most of you probably have gone through mortgage financing, and it was probably pretty rigorous. We double the amount of work when you're doing commercial lending. It is a commercial loan. It's a lot of money. It's a very different animal. There's a lot of work involved in closing. But I would put that in the category of worthy endeavors, meaning it's hard work, but it's totally worth it. But plan on at least 4 weeks there getting through to closing. And, of course, that closing is where the funds are wired. So that's basically the process. So in a very quick manner, what we talked a little bit about is basically 5 different ways, or 6 ways if you want to count it that way, to finance your practice. We talked a little bit about Live Oak. We got into the loan sizes, the loan types. We got into rates, terms. We got into the kind of the financing structures that we see these days, mostly 100% financing. We talked a little bit about how you qualify for that. And then we talked a little bit about process. And with that, Tony, I believe we've got about 7 minutes left. I thought we should throw it back to you just in case there's any questions or comments at the end.
Great. Thank you for that information, John. At this time, we are going to open it up to some questions. And there's 2 ways you can ask a question. Both of them are in your GoToWebinar control panel. One is you can type in a question. I see that we have one, so I'm going to read that off here in just a minute. And the other is to raise your hand, and then I will unmute your telephone line, and we'll be able to have a discussion. So the first question is, are goodwill sales treated as capital gains or income? So Todd, I'm going to give that one to you.
Sure, good question. So the way that the sale price is distributed in respect to taxes is fairly standard in our industry, although it is also somewhat negotiable. Generally speaking, of that sale price, approximately 75 or 80% of it is allocated to goodwill. That would be capital gains for the seller. The buyer would be able to amortize that portion over a 15-year period. The other larger item, let's just call for sake of argument, 15 to 20% of the sale price goes towards consulting, and that's the compensation to the seller for the support of the transition of clients, which is usually a 6-month period. Consulting is ordinary income for the seller. The buyer gets to take that deduction in the year that it's paid. Normally, there's also a small percentage, let's just say 2%, that's allocated to the non-compete language in the agreement. And the reason is non-competes are hard to enforce unless there's a value assigned to them. The non-compete allocation is not a tax benefit to either party, as I understand it. There could also be an allocation to business fixtures, although that's quite rare that the fixtures hold that kind of value that would allow for an allocation. So that's generally what you have is goodwill, which is capital gains, and consulting, which is ordinary income.
Yep. And if I could dive in one additional thing we've seen, and I bet, Todd, you've seen this too, is while it's negotiable, it seems like the IRS doesn't frankly care how it swings because they're going to get their pound of flesh either from the buyer or seller, but there's IRS Form 8594, which is a form that gets completed by buyer and seller with those allocations on it, and it has to agree or the IRS gets very curious very fast. Has that been your experience too?
Yes, we put the allocations in the agreement, and then the 2 parties also have to complete that form as well. What I suggest and what we always suggest is that It's good to understand the industry standards or the norms in our industry, but ultimately that decision should be made by your tax professional who understands your larger tax picture. And so we always defer to our client's tax professional to make that ultimate decision.
We have another question from one of our viewers, and this one, John, is for you. The question is, are your loan rates variable or fixed?
Good question. We have both fixed and variable. The ones that I quoted were the variable. They vary every quarter potentially. There is no cap and there is no floor, so it could go all the way down or it could go all the way up. The fixed rates usually are 100 to 200 basis points higher, and after doing the analysis, what we've discovered is if you plan to hold the loan for the full 10 years, you're probably better off with the fixed rates. If you're going to hold the loan 8 years or less, you think you're going to prepaying it, then you're better off with the variable rates. So just you kind of have to do that question for yourself, but that seems to be the break point, which way you may want to consider going.
And John, we have another question for you. Is there any way or value in getting pre-approved for a loan if they're planning to purchase but they're currently not in contract with someone?
That's a really good question. I do get that question a lot. It's similar to kind of people kind of drawing comparisons with, like, for example, mortgage financing. The largest difference, though, between mortgage financing and commercial lending around acquisition is that with mortgage financing, you have the full picture around the revenue and a pretty good picture around the expenses, so you can pre-qualify. In our formula, you might remember we said the way we qualify you in cash flow is your revenue plus the revenue you're acquiring and your expenses plus any expenses you might inherit. We only have half the formula. If we attempt to pre-qualify an advisor just on their own revenue, we end up with a false negative. We end up with, you only qualify for a very small loan, when in fact, if we can add in the revenue you're acquiring, you actually qualify for a much bigger loan that usually will cover the deal. So the important part in there is, while we can't pre-qualify, we do lots of talking and coaching with you along the way. And when you start talking or working with a practice, when you have a sense of what the revenue and the expenses are going to be, you're going to call me and we're going to get our calculators out. We're going to start doing some of the hand grenade math, if you will, and we're going to walk you in. And as you learn more about the practice, we may end up having another call or two just to keep refining that. But we'll walk you in. And then, of course, you have that proposal letter 2 days after everything is in, where basically we're already at a 95% confidence level. And actually, sellers oftentimes, if the buyer shares it, finds great confidence in that proposal letter. So kind of a long answer to the question, but the short answer is no for certain reasons, but here's what we can do.
Got it. Thanks, John. Well, we're at the top of the hour and we don't have any more questions at this time. So, I want to thank everyone for attending today's webinar. John and Todd, thank you for your great insight today. And I want to remind all of our viewers, if they would like to learn more about what we do, you can visit us at keymanagementgrp.com. And to learn more about Live Oak, you can go to liveoakbank.com. Both Todd and John are more than happy and willing to talk to you about any of your acquisition needs, so feel free to contact them. And again, thank you to our listeners and viewers as well as our presenters today. Have a great day.